So welcome again to Farming Today. This online agricultural conference is hosted by the St. Cloud Area Chamber of Commerce, offering a variety of incredible speakers. It is day 2. We couldn't do it without the support of our sponsors, all of our sponsors, and especially our commodity sponsors, Centricare, Central Minnesota Credit Union, Compure Financial, and Minnesota Milk. So thank you to them. Be sure to check out, I'll be posting their links in the chat, so check out their websites.
Good morning, everyone. Welcome to Farming Today conference. My name is Bernie Quist, and I'm happy to be a facilitator for this first session with Dr. Maren Bozic from the University of Minnesota. Maren is a professor in dairy foods marketing economics in the Department of Applied Economics at the University of Minnesota, and he's here to discuss with us current markets and dairy risk management. Maren, thank you for coming. We look forward to your presentation.
Thank you, Bernie. Thank you for introducing me. I'm going to share my screen here. And Bernie, could you please remind me of how long are we supposed to go for with the first session? Oh, you muted yourself.
You have 45 minutes, Maren.
Okay, sounds good. You know, we professors tend to stretch time, so I want to make sure that I...
And you're welcome to stay after in the room if you'd like, you know, if there is good discussion going on, but people can feel free to leave if they would like to visit another speaker, but feel free to take the time you need, Maren.
Well, so what I want to start is with a picture of me. This is a quote from January 21, 2020. I was down in Madison, Wisconsin for keynoting at Dairy Strong conference. And I said, unfortunately, it was recorded. I said, 2020 will be a good year, a year to reinvest in your resiliency, either through rebuilding your equity or by setting a risk management program for not just next few quarters, but also all the way through middle of 2021. As I was recording that morning, this news broke. The first confirmed case of new coronavirus reported in the United States, according to CDC. So I guess, you know, take everything I say with a grain of salt. You know, beware of economists even when they bear good news, because, you know, shocks and events beyond our ability to predict are always here with us. They're always lurking around the corner. Sometimes those news are great. Sometimes those news are something that turns our world upside down. As far as COVID-19, hopefully we are going back to normalcy soon. So this is a COVID-19 tracking project that looks at COVID tests, number of cases, number of hospitalized folks, and then unfortunately how many folks died on any particular day. And you can see that whichever metric we focus on, it's finally moving in the right direction. So number of daily cases has dropped dramatically from earlier in the year. At the beginning of January, we were looking at 300,000 new cases a day. We're now down to 50, 60,000 cases a day, about as much as we had in early fall or in the peak of summer. I do expect that this trend continues downward. Number of hospitalized Americans is also dropping very, very precipitously from 130,000 early in January to now between 40 and 50,000, and then fewer people are dying as well. This is partially due to, you know, just pandemic making its way through the population, but to a large extent you know, we are seeing the first effect of vaccines. As of today, 1 in 10 Americans are fully vaccinated. Many more have received at least the first dose. Johnson & Johnson is the 3rd vaccine that just got approved a few days ago. It's a single-shot vaccine, and it's effective against severe cases, which is really what matters the most. So we are probably at this point close to vaccinating 3 million Americans a day, at least the first dose. I'm talking about shots in arms. If everything goes according to schedule, if we don't have some nasty variant of the virus that proves resistant to vaccines, I think that by May or June, we could be going, we could be most of the way back to normal. We are already seeing a number of states that are, particularly down south, that have decided that the situation has already improved enough that they have removed all restrictions. For example, restaurants can be fully opened, etc. Going back to normalcy is going to be good for dairy. It's going to boost the food away from home demand for butter and for cheese. I can't wait finally that we get out of the government market and go back to the private demand driving prices. I'm thankful to USDA for their aggressive intervention in 2020 that has propped both block and barrel cheese prices. But enough is enough. Like we have to, at the end of the day, I don't know of a single dairy farmer who would not rather produce for consumers than for government purchases. Now, of course, these government purchases are making their way to hungry Americans through food box programs. But at the end of the day, commercial demand is our golden standard, and that's what we need to go back to. These charts indicate that we are on the way there, and that by this summer we are going to be back to mostly normal demand from U.S. Again, barring any unanticipated new developments. There have been some debate on whether COVID-19 is just a mirage or did it really have a genuine impact on demographics in the United States. And you can see here cumulative US deaths as of the end of year or end of week 52 from 2012 through 2020. And you can see this strong jump between 2019 and 2020. We did in fact lose a lot of our fellow citizens to COVID above and beyond just natural attrition or natural death rate due to other causes. This steep drop in non-farm payroll employment between February and April 2020 is on the way to be recovered. In the fall, it seemed like we were slowing down. I didn't add the most recent data here, but the January and February are again picking up the pace. And we can expect that probably by the end of the year we'll be if not all the way there, then most of the way there. The Biden stimulus bill, $1.9 trillion with a T at the beginning, not even B anymore now, we're talking T at the beginning. And it's about to pass today, as I understand. The House, the Senate has already passed it. House has passed it already. Now they just need to amend it to make it equal to what Senate has passed. And it's going to President's desk. Today, I think that he's going to sign it by the end of the week. That's going to bring a lot of new fresh dollars to many Americans in need, to help them with rent, to help them with food. And it also has a good benefit for dairy farmers because the purchases are continued for another few months through the end of this fiscal year. More on that in a moment. I've already talked about the return back to normalcy. Here's a chart that perhaps better than any other can illustrate how much did we really lose or how much COVID hit us in 2020. This is the open table bookings, so restaurant bookings versus a year ago. And you can see that early in the pandemic, people almost stopped booking tables at restaurants at all. Then by summer, we recovered about 60% of that. But then in the fall, as COVID, the second or third wave became more aggravated, again, people pulled back. I expected this to recover strongly. I think that a lot of us are getting a little bit stir crazy, if we feel that we cannot have our normal social life. So once the restrictions are lifted, I think that we will see a resurgence of interest in congregating in restaurants and visiting with friends and just having a good time. And that's going to be good for cheese demand. I'm going to skip a few slides in the interest of time. The Farmers to Families Food Box Program was one big unknown as we were switching from Trump administration to Biden administration in January. The signature program was strongly promoted was strongly promoted by ex-president's daughter, Ivanka Trump. And there was some concern or even predictions that as the new Democratic president takes over, that the program will be shelved because it's associated with the previous administration. So far, there seems to be, partially to my surprise, I will add, there seems to be bipartisan support for this type of intervention to continue. In the bill that is about to pass, there is more money for food purchases. And at this point, I anticipate that the food box, maybe not under that name, but under a different clothing, if you will continue for the rest of this fiscal year through the end of summer. What I often warn dairy producers is that in the pandemic, we had system-wide shocks, and therefore USDA introduced system-wide intervention measures such as food box program. By the end of the summer, we will be done with system-wide shocks. We will be, the economy will be out of the pandemic mode, if you will. People will, kids will return to school. Folks will go to restaurants again. But it doesn't mean that dairy will be without issues. It just means that dairy will no longer be able to rely on this system-wide interventions such as food box. And to the extent that we may have some oversupply, and that's questionable at this point, I'll talk about it later, we will be left to our own devices to take care of that. We do have a very effective safety net now between dairy margin coverage and dairy risk protection. LGM dairy is unfortunately not used as much. So government will say, well, guys, you have a good safety net. You don't need a food box anymore. I'm talking after summer. So why are you not using your safety net? You know, the situation is not looking dire right now. In fact, it's looking better than I thought, even just maybe 5 or 6 weeks ago, with the milk production growth slowing down. But still, keep in mind that first slide that I've shown you today, with how much optimism I was looking at 2020 on January 21, at the same time when the news was breaking out that a new shock is coming. The central definition of black swans, even though some people will be pedantic and say that the pandemic wasn't a black swan, but the central feature of all these major adverse effects is that the events that you cannot really forecast them well ahead. But what you can do is that you can set up risk management well ahead. So that's part of what we need to talk about today. These aggressive policy interventions have also introduced volatility in the market. So in 2020, we have seen the block prices for cheddar cheese go from some record low levels of $1 per pound to record high levels of $3 per pound in July. And then we really had two such waves from April, May through July, and then again August through October, November. Both waves were driven to a large extent by the government purchases through the food box program. And to the extent that that food box program is now more predictable, longer, and perhaps a little bit more comprehensive than it was last summer. Now you can participate with other types of cheeses, not just cheddar cheese. I would be surprised if the policy introduces as much volatility in 2021 as it did in 2020. And I'm more closely monitoring the impacts of growth in cheese processing capacity this year. I want to talk a little bit about the class 1 formula and also the impact of the food box on the spread between 3 and 4. The reason is that this is going to be, these two effects are going to be critical to explain producer price differentials, which is what I know a lot of producers are asking about. What's going on with my milk check? So the 10 years ago, when we had the last major recession in dairy and in the macro system, USDA was intervening through purchases of bulk products, bulk powder, bulk butter, bulk cheese, and then they would be storing them away. As we were heading into pandemic in 2020, their industries was very clear. We did not want the government to buy bulk products. We did not want them to accumulate stockpile powders, if you will, or butter. We wanted them to focus on products that would be immediately distributed to consumers, so there are no huge stocks hanging over our industry that would slow down the price recovery when the time comes to recover prices. So the policy intervention this year was much more focused on products, in 2020, was much more focused on products that go into class 3 formula, not class 4. So that's cheese. And that drove up the price, the class 3 price relative to class 4 price. You can see that class 3 versus 4 is typically within $1–2 of each other. And then in 2020, that spread by summer. At one point, it was almost $11. And for a number of months, it was above $5. That spread between 3 and 4, that unprecedented spread, has completely turned federal orders on their head. The federal orders are just not designed to handle that kind of spread. That I'm going to explain now why that leads to depooling, why that leads to negative PPDs. The first effect, of course, is trivial. In 2019, we have changed the way we price fluid milk. It used to be the case that fluid milk, that what's formerly known as a class 1 base price, was a higher of 3 and 4. So if you have 3 and 4 that are like this, with 3 being much higher than 4, class 1 would be priced of the higher price. But when you have the average of 3 and 4, what you're really banking on is that those two prices are going to be similar to each other. Well, that's not always the case. When they were very similar to each other back in 2019, in the first 3 months of 2020. And in that environment, when 3 and 4 are very, very close to each other, average off plus 74 cents actually works better for dairy farmers than the higher off. But when you have this tremendous spread between 3 and 4, and if you're writing off the average rather than the higher of those two prices, then you have what you see on the chart here. Then you have the class 1 price $3, $4, $5 lower than what it would have been under the old formula. But that's not the only thing that is driving PPD. PPDs, producer price differentials. You can see that this is from John Newton, my friend, the chief economist of Farm Bureau. So what John really nicely put together here is that across almost all of the orders and across all of the months from June of last year through January of 21, you see negative PPDs. I think that a lot of folks have, I'm going to close my window here because there's noise outside. A lot of folks were somehow got this idea this is all due to class 1 formula being reformed. And that's really not the case. So I've been working on a research last few months with Chris Wall from Cornell University, and we are trying to decompose PPD. In other words, what factors are driving PPD? How much of it is due to advanced pricing? How much of it is due to just long-term trends? How much of it is due to class 3-4 spread, and how much of it is due to 2019 policy intervention? So the effect that I want to emphasize today, that is, I believe, underappreciated, is that, and this is for a central order, but really the slide works for all orders, is that when 3 versus 4, when class 3 rises relative to class 4 prices, then the PPD drops. So what we did in this particular model is that we did away with depooling. We forbid depooling, and we simulated what producer price differentials would have been in each order. I'm showing it for central order. What producer price differentials would be if there was no depooling, if we had higher off price, so no reform in 2019. And the only thing that we are looking at here is the effect of the spread between 3 and 4. We're still, of course, keeping utilization rates similar to how the market really looks like, and the component test, etc. And what you see is this very, very clean downward line that when class 3 is higher than class 4, PPD is lower. And why is that the case? The case that is due to the fact that we pay for protein. When you look at your milk check, you have butterfat test, butterfat price, how much money you get for your butterfat. Protein test, protein price, how much money you get for your protein. Same for other solids. And then some co-ops have recently removed PPD from their milk checks, milk checks. But mostly you would still see the producer price differential as a one more line. Well, people focus on that line with PPD, but really the problem starts with the line where you have protein, because we pay for protein based on the value of protein in only one product, in cheese. And protein, really skim solids, when you put together other solids, which is whey and lactose, and casein, which is what we call protein, when you mix them together, those are skim solids. And we use those skim solids not just in cheese, but we use them in powders, we use them in yogurts, we use them in fluid milk. And when you have this very aggressive government intervention that lifts class 3 price relative to all other classes, then the value of protein, value of skim solids in cheese becomes dramatically higher than what those same skim solids can generate in terms of market returns if they are pushed through the dryer plant or yogurt plant, or even the fluid plant due to the average off instead of higher off. So in other words, we are paying for protein mostly for protein. We are paying for protein more than what the protein delivers in the market, because those skim solids are less valuable in other classes. So we give everybody, we say, okay, here's your protein, here's your price based on the cheese. And then we realize we don't have enough money in the pool, because those proteins didn't really deliver that much money. The processors that use those skim solids to make their products, sell those products on the market, unless they're making cheese, they didn't generate $5 per pound of skim solids or per pound of protein as in some months we had with class 3 and protein prices in 2020. So you have a deficit, and that deficit is then manifested as negative PPDs. So what I want to show you here is a decomposition of Federal Order 30. This is our order, Upper Midwest. This is for January 2021. And when people say, well, producer price differentials are low, I have to ask low relative to what? So we developed this baseline PPD. Baseline PPD is sort of like the good old times. If we were back in January 2010, so 10, now 11 years ago, if we had the fluid relative utilization as we had back then, if we had component tests as we had back then, if we had the average prices as we had over the last 10 years. So this is sort of like your old equilibrium, if you will. And the old equilibrium is going to be different for every market order, because in Upper Midwest, vast majority of milk goes for manufacturing milk. Even our old equilibrium PPD wasn't very high. So I'm pegging it at 29 cents per hundredweight. And then the first thing that hits you is really nothing that is specific to 2020. The first thing that moves that PPD down from that from the equilibrium 10 years ago are the long-term trends. And you have two long-term trends that are driving PPD down. First, of course, anybody will guess, is the reduction in sales of fluid milk, of beverage milk, combined with the rise of manufactured milk. So a smaller share of our milk in the Federal Order 30 is going for fluid than it did 10 years ago. The second trend that is perhaps not as obvious is the rise in protein tests. As I explained moments ago, because we pay protein based on the value it has in where it's most valuable, which is typically class 3, and those proteins are used elsewhere as well, when protein tests trend upward, as they did over the last 10 years, we have to dip into PPD dollars to pay for that protein. So everybody ends up subsidizing essentially high component herds, through the, I'm gonna get in trouble for saying this, but it's true. And that we really draw from the PPD dollars to pay for protein prices. when protein prices, because protein prices do not reflect, where everything else where that protein is used. Nothing that I'm saying is advocacy for a different approach. I'm just trying to explain to you the consequences of the system we have right now. So the long-term trends already eat almost half of that 29 cents long-term equilibrium, or the 10-year ago equilibrium PPD. So you're now at what, about 15 cents above zero. Then you have some seasonal factors, from month to month, from year, like within a year, the fluid utilization goes up and down with schools, with how people eat in particular parts of the year, with component tests in different parts of the year, but that's mostly noise. In January, that's only 3 cents down. That's not something to worry about. But here's the part that's critical. This spread between 3 and 4, even if we had no depooling, imagine that everybody's pooled, we will still have a PPD negative, because that alone, in combination with these other factors, would bring PPD to about negative, what this is, 15, 12, negative 12 cents per hundredweight. That, so you don't need the average off. You don't need advanced prices. You don't need the pooling to explain negative PPD in January in Upper Midwest. All you need is long-term trends and the spread between 3 and 4 and the way we pay for protein. And then, of course, add to that the advanced prices and Class 1 policy reform that did contribute in January a little bit more negative. That's another 9 cents negative. And that, so you're sitting now here, everybody's still pooled, at least in this thought experiment, and cheesemakers are going, you know what, I don't want to be part of this. Federal orders are something where, I provide service to the fluid milk. I have to be ready to serve them or ready to use that milk when they don't need it. And as a compensation for that, I get some draw from the pool. That's the normal state of things. The normal state of things is we have federal orders so that farmers from different regions wouldn't go into civil war over fluid sales. But everybody participated in sharing revenue from fluid sales, and everybody should get a little bump on their milk checks because of it. So the cheesemakers are going, what? Because you never know what's going to happen with PPD next month, and you want to be able to come back, but they depooled a lot. And then the depooling then adds another 72 cents to negative PPD. And that's how you end up with 92 cents negative PPD in Upper Midwest in January 2021. So everybody will focus on this part here, on the depooling. Everybody will focus on Class 1. What I'm here to tell you today, that at least for January 2021, at least for Upper Midwest, PPD would have been negative even without those two effects. The depooling is an induced effect. The way we pay for protein and the spread between 3 and 4 that is currently so large is sufficient to drive PPD in the negative territory in the Upper Midwest. And again, the system made a lot of sense 20 years ago when it was conceived. We certainly understand here in Upper Midwest that our future is not in fluid milk, but in products that we can ship over long distances to where the population is, which means that you have to remove as much water from it as you can, and then ship the solids. So it makes all the sense in the world to reward people for having higher solids. But that train is running out of gravy, because the fluid milk the sales are dropping down. And we are, and the bucket from which we can dip to in order to pay for higher protein prices than the market average value of those protein, that bucket is getting thin. So I'm not going to go today into how to solve this problem, and it's an active debate, and I think the industry should have a very vibrant debate, and it would be awful if it was just for a few gray heads from ivory towers to come up with a solution. Ultimately, this is a fate of 35 1,000 dairy farms across the United States, or at least majority of them are pooled. I will have some more to say on this topic soon, but for today, I just want to impart on you that it's not just about the pooling, it's not just about Class 1 reform of 2019, there's more to it. And these spreads between 3 and 4 are turning the markets on its head. We had a question here. The question was, what are your thoughts about long-term impact on the economy, and more specifically the ag economy, as we as nation deal with a large government debt balance? I think that what helps us still is that US dollar is a reserve currency. And at least as of today, there isn't a viable competitor for the throne. Euro, I don't know. People think, European Union may collapse in 10 years. So euro is not, everybody's favorite. Chinese currency, well, they're about to attack Taiwan in 6 years. Who wants to be in that currency? Japanese yen, they are losing population. They are not what they were in 1980. So wherever you look around the world, there still isn't that one viable alternative to US dollar. And once that happens, we are going to have a day of reckoning with this profligate spending from central government. But until that day happens, because we can borrow in dollars and we control the printing machine for dollars as well, and because the demand for dollars is high around the world, the consequences for federal government borrowing large sums of money are quite different than what it would be for any one individual family to borrow, relatively speaking, that much money for their stimuluses, for the kids or something like that. I'm also closely monitoring what the developments in the cryptocurrency sector. Some folks say that that's going to be the new reserve currency, and certainly you see some large companies, Forbes 500 companies, are now starting to keep part of their cash in Bitcoin or other coins, crypto coins. I am not yet convinced that that's the path to go. I mean, think about it. If we have a large electromagnetic storm, sun just flares and it happened 100 years ago, and all our electrical systems go down, what then? We just stop transacting, because you cannot transact without internet with Bitcoin. You cannot mine without somebody mining Bitcoin actively to verify the next transaction. You just cannot transact. Imagine if like something happens to the sun and you lose everything in your wallet. Like, there's a reason why people through the years have relied on currency that can withstand large systemic disruptions to the infrastructure. Hoarding gold and being an example. So I think that all things considered, we probably still have some leeway, but I hope we don't abuse it too much, because when you have these large trillion-dollar stimulus bills and one after another, as if there'll be no future pandemic or any other sort of catastrophe, I think that it's really testing the patience of everybody around the world who's using dollars, and more people are thinking, how do we stop our addiction on dollars? So anyway, that's a little bit a segue away from PPDs. I want to switch gears here and talk about DRP a little bit. 2020 was a watershed event. The COVID was a watershed event for dairy risk management. Heading into 2020, you can see that about 20% of milk in the United States was using DRP. And then when it became clear that we are going to have a pandemic, that share of milk cover jumped almost 10 percentage points to over 30% of US milk cover. Now it has come down since last two quarters, quarter 4 2020 and quarter 1 2021. We've seen less milk cover than the Q3 2020. But the way I look at it is that third quarter 2020 was really above the trend. If you draw a trend line here, 2020 second half of 2020 was really much above trend. Like the adoption rates were accelerated there, and I think there was going to be some pullback there. I still think that we are going to have in 2021 between 20 and 25, 27% of milk covered through DRP. I don't think that we are going back to the teen numbers, and I think that we are quickly approaching the time where whenever you talk to your lender and say, I want a new operating loan, I want to build a new barn, I want to do this or that, they will ask you, what are you using for risk management? And they might not say you have to use DRP, but they will certainly want to know that you have a plan in place that is active, that is disciplined, and that is consistent. And that is probably going to come down to dairy margin coverage for farms up to 200, 250 cows, and DRP for everyone else, unless you really can convince them that you are using futures and options or LGM dairy as a substitute for DRP. I think that we are going to get to that threshold that's just an accepted practice, that you have to have something on the books at all times if you want to get the next loan. So if you're not already working with any agent, I would advise that you start, put this part of your house in order. Certainly, I hope you have subscribed to or signed up for, dairy margin coverage. We'll talk about that a little bit more. But if it's either LGM or DRP, you have to have something on the books. Otherwise, it won't be long before you get into trouble with your lender. When you look at when was the monthly sales in terms of pounds covered for DRP, you can see that this big increase in March 2020 was mostly fear-driven. People were just like, holy moly, what's going to happen with my farm in the next 12 months? I better put in coverage. So it's quite defensive, quite fear-based purchases, and there has been some drawdown after that because people just booked it early. But last few months already indicate that the pounds covered are recovering, and the sales are again reigniting the power. When you look at the premium amounts, this is the producer premium amount. We are at the point, or have been at the point last few months, where every single month dairy producers commit to paying between $20 and $30 million in premium for the coverage that they have put in that month. We'll see some of that retraction. I don't think that it's going to stay as high as this, but we are in a new era there. This is what I want to show you. This is California, but the prices would be very similar if we were to show Minnesota, at least directionally. Maybe they will be lower, but directionally they will be the same. So what I have here are DRP premiums day by day from the first day the DRP went on sale on October 9, 2018 through last week. And this is for a quarter. This is for the quarterly insurance period that's about a year out. And you can see that we were down, between 20 and 25 cents per hundredweight. This is for producers until the pandemic struck, and now we are mostly in this 40-odd cent range, up and down, like from week to week. But we are in a quite different level than we were in 2019. So the question I get often is like, well, which one is normal? Are we going back to 2019, or is 2020 or 2020 premiums are new normal? So in order to answer that question, I have here the class 3 implied volatility going all the way back to 2008. I apologize for having small font on the bottom. This is a very, very recent chart, so it's not yet as pretty as I want it to be. So here's what I want to show. The DRP premiums are derived from class 3 implied volatilities. That it's almost a linear relationship there. I think I would need to do some more analysis, but it's certainly proportional. Lower implied volatility means lower premium. Higher implied volatility, higher premium. So you can see that here we went from some 12% to 26%. or or so in implied volatility. So just a little bit over doubling. And then when you look at the premiums, we went from 25 to nearly 60 early in the pandemic. So it's about 1-to-1. Is a rough rule of thumb between implied volatility and the premium. So 2020, yes, is extremely high, even historically looking. But 2019 is actually historically low. So we may come down with premiums relative to what we had in 2020. I don't know that we will go all the way down to 2019. We are probably going to land somewhere in here, in this range between 15 and 20% implied volatility. And that would mean maybe 30% cheaper premiums eventually than they have been in 2020, 40 maybe, but not all the way down to what we had in 2019. There are two other factors that I'm monitoring there that may make me change my conclusion. First is that we now have more than 50% of milk in the United States subject to supply management, led by cooperatives, not national program, but led by cooperatives and private processors. That does curb the rate of growth. We have seen that in November, December last year, our rates of growth were over 3%. We were running out of processing capacity, and a lot of processors have turned their supply management programs back on, and the rate of growth in milk for January has dropped in half relative to what we had in the fourth quarter of 2020, maybe thereabout. So when we have these more moderate rates of growth in milk production, then we will have fewer supply-driven shocks to the prices. That may stabilize the markets, and that may cause DRP premiums to be cheaper. The other factor is that we may see some more hedging being done on CME, if not directly by dairy producers, then by folks that ultimately warehouse the risk that that dairy producers have offloaded by buying DRP. So when you buy DRP, it doesn't all go to the central treasury. Typically, what happens is that 2/3 of your risk is borne by the government, but 1/3 still stays with private companies that provide DRP, whether they're insurance carriers or reinsurers. And those companies have seen losses in 2019 and 2020. They're worried about them, and they are actively thinking about how they can manage that risk. And some of them may be coming to CME soon, and we need to monitor what will be the impact on implied volatility and futures prices as they do come back. So in short, if they start buying puts, that through the hedging pressure may elevate implied volatility a bit higher. Okay, so I think I'm out of time here. I have about 40 more slides, but 0 more minutes. So rather than maybe I should just go through DMC and wrap up there. That seems very important. So what I have here are from a week ago. Forecasts for all milk prices, corn, blended hay, soybean meal, feed cost ration, and then finally dairy margin coverage margin for 2021. And most of Minnesotans have protected $9.50 through DMC. Average margin for the year is $8.12. For a lot of, because of this is driven by higher feed costs, and so a lot of, other than the last 3 months of the year, margins are below 9. When you translate this to how much you would get paid, so I have an example here of a farm with 8 million pounds in covered production history. First 5 million at $9.50, the second tier at $4. First of all, second tier is not forecasted to pay anything, but the first tier we are looking at quite substantial payments. Let me see if I need to lift this a little bit. There you go. So quite substantial payments for a farm that has full 5 million on the books with FSA. Forecast as of last week was close to $70,000 in payments. So DMC has seen enrollment rise 30% versus last year. I have a new grant with FSA to build the next iteration of the tool. What you see on the screen is going to be freely available to everyone as an Excel file they can download and then refresh from their own computer. Just press a button and the forecasts come to you at no charge to any dairy producers, no credentials needed, no private information sent back to the servers. So you'll be able to plug in your own pounds and what you have done, press a button, and then see what your forecast is for the year. How much are you going to get paid? We hope to roll that out in the next few weeks. We are in advanced stage of prototyping that now. Bernie, I think this might be a good stopping point. It's 9:47. So back to you.
Thank you. So let me think I'm still live. Thank you so much for that, Marin. I really appreciate the amount of information and the variety of information that you're able to tie all these things together. We realize, and I guess it's been brought to our attention, how one part of the sector really impacts another. And it really is important for us, I think, in agriculture to realize how important it is and how much we are a part of that. So again, I thank you for that. There's a lot of information you provided. This is being recorded, so if we need to go back, we have that, but I appreciate your availability and sharing that with us today.
Of course, my pleasure. Are there any questions I can answer from anyone? Okay.
You can type it into the chat, or you can unmute yourself, whatever is most convenient for you. Hearing none at this point, Marin, thank you again so much. Thank you all for joining us, and we welcome you to other speakers this afternoon, or the rest of the morning, I should say. Thank you.
Enjoy the rest of your conference, everyone. Have a good day.
Thank you, Marin.